Lebanon. For decades, Lebanon's stability rested on a fixed exchange rate and a banking-driven economy fueled not by real production, but thanks to extended remittance practices consisting of non-commercial transfer of money by foreign workers, members of a diaspora community, or citizens with familial ties abroad. Behind the calm was a fragile system, borrowing new money just to repay old debts. In October 2019, frustration over corruption and new taxes ignited mass protests. Foreign inflows dried up, and the central bank could no longer defend the Lebanese pound's peg of 1,500 units per dollar. By 2021, the currency had lost more than 90% of its value on the black market. Banks froze accounts, inflation topped 200%, and food prices tripled. The middle class collapsed into poverty, and Lebanon's once proud banking system went insolvent. By 2023, the country was still trying to rebuild. Public debt soared past 280% of the gross domestic product, and daily life ran on US dollars instead of the local pound. A generation's savings were erased, a slow-motion collapse that Lebanon has yet to recover from. If this hyperinflation event unraveled in slow motion, the next compressed years of damage into a single budget cycle. Ecuador. Ecuador entered the late 1990s with weak banks, heavy external debt, and falling oil revenues, its main export. Political instability and poor fiscal control left the Ecuadorian sucre vulnerable. In 1999, a domestic banking crisis erupted. Major banks failed, depositors panicked, and the government froze accounts. Confidence in the Ecuadorian sucre collapsed as inflation and capital flight surged. The currency plunged. In 1999 alone, the Ecuadorian sucre lost around 70% of its value, and inflation topped 90%. By early 2000, hyperinflation was looming. The government could no longer stabilize prices or pay public salaries. In January 2000, Ecuador made a drastic move. It abandoned the Ecuadorian sucre and adopted the US dollar as its official currency. This reset successfully ended hyperinflation and brought stability, but it cost the country control over its own currency. For many Ecuadorians, dollarization saved the economy, but it also cemented inequality for years to come. If Ecuador forced an economic reset within a year, the next drove crowds to the banks in mere months. Argentina. In the 1990s, Argentina looked unstoppable. Its convertibility plan pegged one Argentine peso to one US dollar, creating a sense of stability and trust. But that same peg became its downfall. The government borrowed heavily, exports slowed, and Argentina couldn't devalue its currency to stay competitive. By 1998, the economy slid into recession. Investors pulled their money out, tax revenues collapsed, and national debt kept climbing. As the US dollar strengthened globally, Argentina's exports became even less competitive. By late 2001, panic took hold. The government froze bank withdrawals with a procedure known in the economics books with the term corralito to stop bank runs. Riots started. The peg finally broke in January 2002, and the Argentine peso lost about 70% of its value within months. Argentina defaulted on over $100 billion of debt, the largest sovereign default in history at the time. Unemployment soared past 20%, poverty doubled, and the middle class was completely devastated. Argentina eventually recovered through devaluation and exports, but the one-to-one dream ended in social and financial damnation. If Argentina's peg break seemed sudden, the next squeezed the timeline into a 2-month nosedive. Turkey. The 1990s left Turkey with massive budget deficits, weak banks, and unstable politics. The government relied on short-term, high-interest debt to stay afloat, leaving the country dependent on foreign capital. Inflation was already around 40%. In February 2001, a public argument between the president and prime minister shattered confidence. Panic levels rose overnight. Investors fled, the Turkish lira came under attack, and markets crashed. The central bank tried to defend the currency, but quickly burned through its reserves. Interest rates spiked above 3,000%. The Turkish lira lost more than 40% of its value in 2 months, and several banks neared collapse. The government abandoned the peg and accepted a $16 billion rescue from the International Monetary Fund. Inflation soared past 70%, unemployment jumped, and living costs went through the roof. Yet the painful reforms that followed restored stability. By 2003, Turkey's economy had begun to recover. a hard reset from disorder to discipline. If Turkey's economic crisis strained for a few months, the next would snap within a handful of weeks. Mexico. With Mexico, it was a totally different story. Through the early 1990s, Mexico looked stable. A fixed exchange band kept the Mexican peso tied to the US dollar. Inflation was low and foreign investors poured in. But this stability was fragile, built on short-term capital and a rising current account deficit. In December 1994, political shocks, 2 assassinations, regional unrest, and shrinking reserves completely shattered investor confidence. The central bank tried to defend the Mexican peso, but its dollars were running out fast. By Christmas, Mexico was out of reserves. The peg broke. Within weeks, the Mexican peso lost over 50% of its value against the dollar. Banks wobbled, pension funds collapsed, and panic spread through Latin markets. The shockwaves even hit Wall Street. The US and the International Monetary Fund rushed in with a $50 billion bailout, stabilizing the system but forcing Mexico into years of spending cuts and slow recovery. It was another brutal reminder that even stable economies can collapse in a matter of weeks. And if Mexico fell in weeks, the next tumbled in days. Brazil. Throughout the 1990s, Brazil relied on a currency stabilization plan called the Real Plan, which pegged the Brazilian real to the US dollar through tight control and heavy borrowing. The system kept inflation low but built massive external debt. When Asian and Russian crises hit in 1997 and 1998, investor confidence in Brazil's overvalued currency began to crumble. In early January 1999, speculative attacks intensified. Brazil's central bank spent billions defending the real, but reserves fell by half in just weeks. Political tension within the government over how to handle the crisis finally broke the peg. On January 13, 1999, Brazil let the real float. In a matter of days, it lost about 40% of its value against the dollar. The stock market plunged, inflation fears spiked, and capital fled. The International Monetary Fund stepped in with a $41 billion support package to stabilize markets. Within months, inflation eased, and Brazil slowly regained control under a managed float. The 1999 crisis taught emerging economies the danger of defending an unsustainable peg with borrowed money. If Brazil's economy collapsed in days, the next one disintegrated overnight and lit a fuse across a region. Thailand. By the mid-1990s, Thailand's economy was booming on cheap foreign loans. The Thai baht was tied to the US dollar, property prices were climbing fast, and local banks continued to borrow in dollars to keep the boom going. But beneath the surface, the economy was dangerously unbalanced. In early 1997, investors started betting that Thailand couldn't keep defending its currency. Speculators attacked the Thai baht, and the central bank burned through billions of dollars trying to hold the line. By July 2, 1997, the reserves were gone. Thailand finally gave up and floated the baht. Its value crashed by almost 50% overnight. Panic quickly spread across Asia, hitting Indonesia, Malaysia, and South Korea. The regional boom turned into the Asian financial crisis. Because many companies had borrowed in US dollars, their debts suddenly doubled in local currency. Businesses went bankrupt, banks collapsed, and economic growth stopped almost instantly. The International Monetary Fund stepped in with a $17 billion rescue package, demanding major economic reforms in return. The crash ended Asia's decade of economic miracles, showing again how one broken currency peg could bring down an entire region. If one night could rattle a region, the next raised the stakes with a sovereign default that shaked markets worldwide. Russia. After the Soviet collapse, Russia's new market economy was drowning in debt. The government financed chronic budget deficits by issuing short-term bonds called GKOS, often at interest rates above 100%. Still, falling oil prices in 1997 and 1998 killed revenues, while tax collection barely functioned. In August 1998, investors lost all faith. Foreign lenders pulled out and the state's reserves evaporated. The Russian ruble came under massive pressure as the central bank tried and failed to defend it. On August 17, 1998, the Russian government devalued the ruble and contemporarily stopped making payments on home debts and froze some payments owed abroad. Within weeks, the Russian ruble lost 2/3 of its value. Banks collapsed, inflation soared, and imports just became unaffordable. The crisis wiped out savings and trust in financial institutions. But as oil prices recovered in the early 2000s, Russia was finally able to stabilize under new leadership. If Russia smashed balance sheets, the next shattered price tags faster than paychecks can catch up. Weimar Republic. Immediately after World War I, Germany was buried under reparations it just couldn't settle. The empire was gone, the economy shattered, and industrial output barely half its pre-war level. The new Weimar government had mountains of debt and almost no way to raise revenue. Besides sustaining the internal economy, paying wages and pensions, the Weimar government was forced to pay war reparations to the Allied power. This was settled during the Versailles Treaty signed in 1919, the most important peace treaty of World War I. Desperate, the Weimar government began printing money to pay wages, pensions, and reparations in paper marks instead of gold. Despite printing fresh money, Germany missed reparation payments. As a consequence, France and Belgium military forces occupied the Ruhr, Germany's industrial heart, in 1923. This set the stage for a global strike of workers, and the government would continue paying them with newly printed money. This process of generation of value not backed by any gold reserves would destroy the German economy. The German mark's value finally disintegrated in late 1923. Prices doubled every few days. In less than a year, the US dollar jumped from 4.2 German marks to over 4 trillion German marks. Families carried cash in wheelbarrows. Shops changed prices 3 times a day. Germany eventually scrapped its currency and created the Rentenmark, backed by land and industry. If Weimar doubled prices every few days, the next doubled them by the next day. Zimbabwe. After controversial land reforms in the early 2000s, Zimbabwe's agricultural base, once the backbone of its economy, collapsed. With exports gone, tax revenue vanished. The government began printing money to pay wages and debts. By 2007, inflation was already over 1,000%. Price controls, shortages, and fiscal deficits spiraled out of control. Then came the free fall. By November 2008, prices were doubling every 24 hours. Annual inflation hit an almost unbelievable 79.6 billion%. Shops priced goods in trillions of Zimbabwe dollars. Citizens carried stacks of notes just to buy bread. In 2009, Zimbabwe abandoned its own currency altogether, allowing trade in US dollars and South African rand. It was an unofficial dollarization born of desperation. The move ended hyperinflation overnight, but erased people's savings completely. It remains one of the most extreme examples of monetary collapse in human history. If Zimbabwe burned by the day, the next burned by the hour. Hungary. World War II left Hungary in ruins. Entire cities were destroyed, railways gone, farmland seized by armies. The government faced no tax base, massive debt, and reconstruction costs. With the economy paralyzed, officials began printing the pengu to cover deficits. When the Soviet army occupied the country and the old government collapsed, people lost all confidence in the currency. Businesses refused to accept pengu at official prices, pushing the state to print even more money just to function. It became the worst hyperinflation in recorded history. Prices doubled every 15 hours. By mid-1946, a loaf of bread cost 1.6 trillion pengu. The largest banknote issued carried 100 quintillion pengu. The money became literally worthless. Hungary then introduced a new currency, the forint, at a rate of 1 forint equals 400 octillion pengu. The reset restored order, but the trauma left Hungarians deeply distrustful of paper money for generations. If Hungary set the speed record, the next set the scale, stretching collapse into a national exodus. Venezuela. For years, Venezuela lived off oil. By 2014, 96% of its exports came from crude oil. When global oil prices collapsed, the country's fragile economy, already burdened by subsidies, corruption, and huge fiscal deficits, began to fall apart. In 2016, government revenues plunged as oil fell below $40 a barrel. To keep funding social programs and wages, the central bank began massive money printing. Inflation accelerated from 800% in 2016 to over 1,000,000% by 2018. The Venezuelan bolivar lost over 99.999% of its value in 3 years. Supermarkets were empty, cash became useless, and people fled the country by the millions. The International Monetary Fund called it one of the worst hyperinflations in modern history. The government redenominated the bolivar, cutting 5 zeros, then another 6 in 2021, and introduced limited dollarization to restore stability. By 2020, inflation slowed, but the cost was devastating: lost savings, mass emigration, and a nation trapped between collapse and survival.